Tom mentioned, my name is Mike Dieckman. I'm with Wisconsin Business Development Finance Corporation. That's the long name, WBD. Thanks. I think is the name that most of the lenders throughout the state know us as. We are a private nonprofit company. We're actually headquartered in Madison, but we do have offices throughout the state. And so locally, Eau Claire and Hudson are our two local offices. And from those offices, we cover basically the western third of Wisconsin. We also can get into 14 counties in Minnesota. So covering a pretty good geographic area between myself and Jeremy for the past 6 years have covered this area. We will be looking at filling Jeremy's spot in our Hudson office, and those are some pretty big shoes to fill. But we are what's called a certified development company, and all that means is that we are certified by the U.S. Small Business Administration, better known as SBA, to deliver a specific loan program to lenders and small business owners or aspiring small business owners. The program is called the 504 loan program. Been around since the early 80s. Was put in place by an act of Congress. They passed a bill that had the number 504 in it. They got real creative and called it the 504 loan program. And so what I tell people when I sit down and first meet with a banker with their client is that the quickest, easiest way to remember it is fixed rate financing for fixed assets. And if you look at those kind of one at a time, fixed assets, land, buildings, equipment, and kind of my tagline is that if you are looking as a borrower to buy a building, build a building, or purchase equipment, or a combination of those, and your fixed asset costs are, say, $300,000 on up to could be $5–10 million, then it's a program that we think is worth looking at. As far as from a lender standpoint, it's very attractive because they're going to get a first lien or a first mortgage on that project. And what I should also mention is that we are always partnering with lenders from banks, credit unions, so forth. So you can come to us and say we'd like a 504 loan, but we're going to say, okay, who is your lender? Or we'll help you. We'll give you 3 or 4 names of some people that you can talk to that we've partnered with in the past. If everyone has, or most of you have, one of the sheets that I handed out here, it gives you an example. Just use a $1 million project, and again, we're involved in some very large projects, some multi-million-dollar projects, but a lot of our projects are of that $300,000, $400,000, $500,000 variety, so it doesn't take a real large project to use the program. In this example, I used $1 million, and what you can see on the right-hand side of how that is broken down, where you've got bank financing, generally comes in around 50% of the project. The SBA 504 piece generally fits within 30 to 40% of a project. I've got it here at 40%. And then we use the term borrower contribution for the 10%, and that generally ranges from 10 to 20%. What drives that is that if it's an existing business in a multi-purpose building, then we can get in for as little as 10%. However, it's a startup, or if the building would be considered special purpose, then it jumps up to 15% that's needed. Or if it's both, it happens to be 20%. But most of the projects that we're involved in come in at that 10 or 15% equity contribution piece. The one other thing to note there is we call it borrower contribution in its truest sense of the word. If it comes in as cash, that's wonderful. But a lot of times people don't have 10 or 15% cash sitting around. So that can take a number of forms. It can be land provided by a municipality. It could be existing equity that you already have in a property that you're going to use for that project. It can be seller financing in certain circumstances. So we're pretty flexible. And we do, and Levi talked earlier, they even have an exception to policy where their loan funds can be used as borrower contribution to get a deal done. So we try to get pretty creative to make something happen. The good news, bad news is that there are fees associated with the program. That's the bad news. You can see how that shakes out. The good news is that they are financed as part of the loan costs and built in, so they can be, they don't have to be out-of-pocket costs. From a benefit standpoint, I mentioned again the bank comes in and their loan is generally around that 50% piece, and they're in a first mortgage or first lien position. So it greatly reduces their risk, greatly reduces their exposure, makes them more comfortable going to their board, what have you, and getting the deal done. From a borrower standpoint, two real big advantages: that low down payment, 10 or 15% usually, versus if you're going to the bank and they're wanting at least a lot of times 20, 25, sometimes even 30%. That's if they can get the deal done at all. If it's a startup business, it's a risky industry, what have you, they might say, you know what, it's just doesn't fit inside of our box. Hopefully they would then come to us and say, we've got a way to make this happen. We can get comfortable on our end, but we can also provide you with some benefits as well as the business owner. So from the borrower benefit standpoint, that low down payment, but then also what the program allows you to do is access a long-term fixed rate. The funding for the 504 program comes from the issuance of 10 or 20-year government guaranteed bonds. So just like many of you have 15 and 30-year fixed rate mortgages on your homes, in this case, you can get a 10-year fixed rate if it's an equipment project. You can get a 20-year fixed rate if it's a real estate project. Many of our projects are mixed-use projects. So if someone is going to build a hotel, and let's say it's $2 million to build the facility, and you need another $300,000–400,000 for the beds, the TVs, the so on and so forth, we can build that all in as long as the lion's share of the assets being financed are real estate. Then we can do that all within a 20-year 504 loan. We work with just about every industry under the sun. It could be larger manufacturers, it could be companies like OEM, and it could be a daycare, it could be a vet clinic, what have you. We have about 1,300 loans in our portfolio, and there's plenty of hotels, bars, restaurants, convenience stores. Those are the ones that kind of come to mind. A lot of bankers think, okay, well, those are the real risky things. We're going to use the program for those. But really a wide variety. I mentioned daycares, and we've got quite a few of them in our portfolio, and overall they've performed quite well. Just, I guess it's a sign of the times, but in the last 3 years we've approved 3 daycares, but none of them involve children. All 3 of them are financing dog daycares. So just kind of odd. The one note there is that it is for owner-occupied real estate. So as somebody from the SBA said a long time ago to me, just remember it's the Small Business Administration, not the Small Landlord Administration. So if it's just purely investment properties, then we can't get involved. But oftentimes we are doing this in partnership with other federal, state, local agencies. It's very common for Beth and Levi from the regional planning to also come into the deal. We find a way to we basically find a way to get the deal done. A combination of the key there is to have the bank or credit union, ourselves, and then whoever else we can bring in to make the deal go forward. So I think I rushed through that kind of quickly. I certainly will be around for questions afterwards, but appreciate your time.